All right, let's jump right into it. If you've been watching the markets lately, you're probably wondering why mortgage rates just completely refuse to budge, why stocks seem to randomly freak out every couple of months, and why the Fed can talk openly about cutting rates, but money still feels incredibly tight. It's a huge puzzle, right? Well, to figure out this financial whodunit for today's explainer, we actually aren't looking at Washington or Wall Street. We're going to look at a totally obscure underlying global shift that is quietly driving the entire U.S. economy.
If you turn on financial TV right now and ask what the biggest risk to the economy is, you're going to get the same predictable answers. People will tell you it's the AI bubble bursting, maybe rising geopolitical tensions with China, or the endless political gridlock in D.C. But actually, scratch that. The real threat is hiding in plain sight, and it is over 6,000 miles away in Tokyo.
Yeah, no way it's AI or China. The real culprit holding the global financial system together is Japanese government bonds. I know, literally the most boring asset on planet Earth. But the country that gave us incredible tech and attracts millions of American tourists has quietly acted as the absolute duct tape of the global financial system for the last 30 years. You don't hear about it much because it requires going pretty deep down the finance rabbit hole. But that financial duct tape, it is starting to peel. To really get why Japan is the key to all of this today, we have to rewind back to 1992. Japan had just gone through this massive, catastrophic asset bubble burst. Real estate crashed, equities crashed, and the whole country entered what we now call the lost decades. It was basically a 30-year stretch of just stagnant growth. No inflation, zero wage expansion. It was like the entire Japanese economy just hit pause. Fast forward to 2024, the Bank of Japan has finally shifted gears. But that long period in the middle, that is where the foundation of the modern global economy was totally rewritten. See, during those lost decades, the Bank of Japan had to do something, right? So they did what central banks do when they literally run out of options. They cut rates to zero. And then they went below zero. When even that didn't work to stimulate growth, they rolled out yield curve control. Think of it as a policy that artificially caps long-term bond yields by essentially supergluing interest rates to the floor. They absolutely forced their domestic bonds to yield nothing, whether the market liked it or not.
So think about the side effects of a policy like that. Imagine you're managing a massive Japanese pension fund with billions of dollars. Your domestic government bonds are paying you exactly 0%. You can't survive on a zero return, so you are literally forced to go shopping overseas just to find some yield. Because of this dynamic, Japan went on a multi-decade global shopping spree. They bought up foreign assets relentlessly, and ultimately Japan turned into the world's largest net creditor nation. They basically became the world's ATM.
And here is exactly how they pulled it off. It's a mechanism called the yen carry trade. Let's walk through it. Say you're a massive institutional investor. Step 1, you borrow money in Japan, in yen, at basically 0% interest. We are talking practically free money. Step 2, you convert that yen into US dollars. Step 3, you take those dollars and buy US treasuries that are yielding, let's say, 4%. Step 4, you pay your small hedging costs, sit back, and pocket that sweet spread. It was, for sure, a license to print money.
But here's why this matters to all of us. When borrowing costs are that close to zero, investors don't just stop at boring U.S. treasuries. Oh no, they buy tech stocks, they buy real estate, they buy emerging market debt. Seriously, if an asset had a pulse and yielded more than 0%, Japanese capital bought it. Because of this massive shopping spree, global markets were basically running on Japanese Wi-Fi. This carry trade created one of the largest sources of global liquidity in human history, estimated to be in the trillions of dollars.
But there was a catch. That entire trillion-dollar global system relied on one incredibly fragile assumption, that Japanese yields would just stay at zero forever. Well, in 2024, that assumption broke. For the first time in 17 years, the Bank of Japan actually raised interest rates, and then, a little while later, they raised them again. The era of superglued 0% money was officially over.
And man, the market reaction was violent. Right after that second rate hike, global markets officially completely spooked. In just a single day, the US S&P 500 dropped by 6%, and Japan's Nikkei 225 plummeted by over 12%. That was its worst single-day drop since 1987. This wasn't your run-of-the-mill market pullback. This was a giant, flashing red warning sign that the foundation of global liquidity was cracking.
Because when Japanese yields rise, the fundamental math of the entire global economy changes. Borrowing yen suddenly gets more expensive. Hedging against currency risk gets more expensive. So all of a sudden, that 4% US Treasury trade, it's not a no-brainer anymore. The spread just vanishes. The whole free money trade that fueled global markets for decades was effectively killed dead in its tracks, which triggers this massive event called repatriation. It's pretty simple. When the math on a trade flips, the capital flows flip right along with it. The trillions of dollars that flowed out of Japan for decades, they suddenly started reversing course and returning home to Tokyo. That's repatriation. And it is honestly one of the biggest, quietest threats to global markets today, because the cheapest, most reliable source of global liquidity just dried up overnight.
Now, you might be asking yourself, okay, well, why doesn't the U.S. Federal Reserve just step in and fix this? Financial media loves to hyper-analyze Jerome Powell, right? They treat Fed press conferences like it's a Marvel movie trailer. But the reality is, the Fed really only controls short-term, overnight interest rates. The long-term yields, the 10-year, 20-year, and 30-year treasuries, those are controlled by the basic, unyielding forces of global supply and demand. And Japan, they've been one of the biggest sources of that demand. Legendary hedge fund founder Ray Dalio actually hit the nail on the head regarding why this distinction is so incredibly vital. He said, the bond market is the basis. It's the backbone of all markets. It determines what all asset returns are going to be. When the supply and demand picture for the bond market breaks down, like say when your absolute biggest buyer just decides to pack up and go home, it forces long-term interest rates up. And those long-term rates dictate the value of virtually every other asset you can own.
Which brings us straight to the immediate problem for the United States. We run trillion-dollar annual deficits. The Treasury is forced to issue massive amounts of new debt every single year just to keep the lights on and the economy moving. And as that debt grows, someone has to step up and absorb it. For decades, Japan was our most consistent, price-insensitive buyer. So even a slight, tiny reduction in demand from Japan can completely disrupt our long-term yields. And if that Japanese demand vanishes and long-term yields stay elevated, it sets off this really painful domino effect. This is exactly why this matters to your wallet. Elevated long-term yields mean the baseline for valuing stocks goes up, which naturally compresses stock multiples. It means your mortgage rates are going to stay artificially high even if the Fed cuts short-term rates, and that keeps housing transactions muted. It tightens corporate credit, which slows down business growth. It's really an everything story.
So why isn't this everywhere in the news? Well, traditional financial media largely ignores the unwinding of the cross-currency carry trade. Honestly, explaining the complex reallocation of Japanese institutional capital takes patience and a lot of nuance. It doesn't generate those rapid-fire dopamine clicks like shouting about AI or Washington politics does. Instead, they sell us this dramatically oversimplified lie that one single Federal Reserve rate cut is going to magically fix everything, completely ignoring the massive structural earthquake happening right beneath the surface.
As we wrap up this explainer, I want to leave you with one final, kind of provocative thought. The real threats to our financial system. They are rarely the loud, heavily publicized ones. Those are almost always already priced into the market. The real threats are hiding in plain sight. For 30 years, we relied on an endless, flowing stream of cheap global liquidity. So if the world's ATM permanently closes its doors and Japan just stops buying, who exactly is going to step in to buy our massive debt? And more importantly, what happens to the cost of our money when they don't?